Hello everyone, this is Zach here. Together with me, I have Dato Yu again. Okay, today this section here, we're gonna share with you another special topics that I think will excite some of our audience here. Okay, now before we start, however, today this live Facebook section over here, if you are here with me, appreciate if you can help me to click the like buttons for me, help me to share this out. Okay, if my audio and screen is okay, it's working, type a one for me, please. Okay. All right. So thank you for those who are joining us. So today in this section over here, we have a very special topic to talk about the glove sectors. Okay, I think most of us know glove sector actually have been hit badly. Okay, because due to the announcement QR announcement the other day from Hartab and followed by some of the counter also follow as well, especially like counters like Kosan, Top Glove, and even Supermax too. So today we have Dato Yu with us today to look into in terms of fundamental perspective. Okay, whether still worth or not to look into the glove sectors overall. So, without further ado, I will pass the floor to Dato Yu to start our section for today. Dato Yu?
Okay, I presume you all can see the slides. Now, what I'll do is I'll spend about 30 to 40 minutes doing two things. First, I will give you an overview of the sector, how the sector performed. Then I will do a deeper dive into two glove stocks, Top Glove and Care Plus. So the sector overview, when you look at the Bursa glove companies, there are actually 10 players in that sector. Okay, there are actually 7 glove manufacturers. These are the people who actually make the gloves. And there are 3 glove equipment suppliers. These are people who either do the molds for the gloves, the chlorination system, or the glove production lines. My focus, of course, is on the glove manufacturers because that's where I think the bulk of the interest is. Now, the glove industry in Malaysia is basically an export-oriented one. I think the bulk of the gloves are sold internationally. And Malaysia accounts for almost 60 to 70% of the global demand. Okay. We are a big glove player internationally. Okay. And the glove sector, the demand for the gloves actually benefited from the COVID-19 pandemic a couple of years ago. And because of the COVID, they expanded, and the current problems is also due to the expansion during the COVID time. I'll explain a bit more and I'll give you a bit more background on the reasons for this and whether this will take 2 years or will take 10 years to actually resolve itself. Okay, so let's look at the glove company performance. Now, what I've done is that for the 7 companies, I've tracked their performance over the last 12 years. And what I do is for the 7 companies, rather than try to identify the companies, I create what I call a number of key statistics. So the median, of course, is the performance of the company in the middle. So if you imagine if there are 7 companies, the median company is the one, if I rank them from top to bottom, okay, then the median company is around the 3.5 position, okay, if there was such a company. The upper quartile that means 25% of the companies are higher than this company, 75% are lower. And then the lower quartile is what it means is that 75% of companies are higher than them, or 25% is lower. I use this metric because the range between the big companies and the small companies are very great. And I wanted to give you a picture of the range. So I use what I call the interquartile range to show you the performance, and the median to show you what's the most common revenue or metrics for that sector. So you can see that over the past 12 years, revenue trend has been going, and then it peaked during the COVID period. Okay, so the 2 years COVID was a very good year for the glove companies, and the two things that you will notice lah. The first is that the bigger companies benefited more than the smaller companies. Okay, so the big company had a big jump, the small companies only had a small jump. Okay, but when you look at what's happening today, for the median company, the current revenue is about the same as what it was in 2010. Effectively, the sector didn't grow. Okay, the smaller companies' revenue actually is smaller. It's only the bigger ones that managed to maintain a bit of the revenue. But when you look at the revenue during the COVID times versus what is happening today, you can see a very significant decline in the revenue. Okay, and the profit, of course, followed the same pattern, that you have the spike because of COVID, and then when you look at what is happening today in terms of the profit after tax, it is all lower than what it was in 2010. Okay? So you have the bigger companies making more of the profits, okay? But overall, the profits today is worse than what it was in 2010. It's a how do you put it? It's not a very exciting performance when you look at what's happening today. Okay? Now, because of the profit pattern, when you look at the key metric, what I call the return on capital, you find out that whether it is big company, small company, even the middle-sized one, they all suffered declining returns over the past 12 years. Okay, whether you look at look at return on capital, but whether you look at return on total assets or return on equity, you see the declining trend. Okay, so that's the thing that struck me because I'm more used to looking at property companies, and I thought that the property sector over the last 12 years was doing badly, but when I look at the glove sector, I thought, wow, they're worse than us. Okay, the difference, of course, is that they had this big profit spike. Okay, whereas the property sector didn't have that. Now, the key metric in trying to see whether they are going to turn around is this metric called gross profitability. It is actually calculated by gross profit over total assets. And this is a metric that's made famous by this professor called Professor Novimax. And what he found in his studies was that he believes that this metric has a better predictor than price to book value in predicting whether the market price is going to turn around and perform. So when you look at these metrics and you look at what's happening over the last 1 or 2 years, I don't see a turnaround. That's why I worry, because normally if this turns around, then I'm a bit more confident that the fundamental performance going forward is going to be better than what it was a couple of years ago. But when you look at this key metric, okay, gross profitability, you find out that it's relatively flat. Okay, and I'm not sure whether even the average company, there's a slight turnaround. I'm not sure whether the 2025 is going to be flat or is going to be better. Okay, the key message I'm getting is that it's going to be a very challenging sector. Okay, looking at it as a whole. So it's challenging from both a top-line perspective. Okay, you can see revenue being flat over the last couple of years, and even from a margin perspective, you look at the current margin, it is much lower than what it was. Okay, this is the gross profit margin. So there's no top-line growth, there's no expansion in the margin. Okay, normally if the revenue growth is low and you can increase your profitability, you can still increase your profits. But here, the top is bad, the margins is bad. They are going to have a very challenging time in the immediate future. Okay. Now, when you look at the future, okay, and I'm referencing to market research reports on the glove industry globally. Okay, most of them are focusing 5 to 6% growth over the next decade. Okay, So if you remember, okay, that the revenue today, okay, compared to the pandemic time, has dropped by, almost 60-70%. Okay, to recover back to the pandemic time, okay, at 6% per annum growth, you need 10 years. Okay? That's the challenge of the sector, that the revenue today, okay, is much lower than what it was during the pandemic time. But unfortunately, the capacity that they have was geared towards the pandemic capacity. Okay, so let me give you a picture of the capacity picture, because when you compare capacity, okay, and you look at total assets, okay, growth over revenue growth over the past 12 years, you find out that they have been growing capacity much faster than they have been growing revenue. Okay, with hindsight, of course, you can see the industry overestimated, the industry thought that the pandemic will last longer, so that if they all ramp up production, they will catch the wave. But unfortunately, the pandemic was 1 or 2 years, and then the whole demand collapsed. So today, the industry is suffering from excess capacity. Okay? Can you imagine the capacity in 2014, 2015 was about 2 million, talk in terms of 2 billion in revenue terms, 2 billion revenue, they ramp it up, okay? And today, they are stuck with the capacity, but the demand has dropped back to what it was in 2013, 2014. So that's the critical issue of the industry. Now, apart from the top line, okay, because capacity drives the top line, okay, if they can control the cost, then there may be still some hope. But then when you look a bit deeper, you find that they are facing raw material costs, you got higher labor costs, and because of the capacity problem, competition becomes more intense. They have less chance to even increase the selling prices. So the margins are being squeezed. Okay, cost goes up, your selling price been squeezed. You can see the margins going down. Okay, and that has also affected the cash flow. That's a fundamental picture of the industry. The only good thing about the sector, of course, is that when you look at the financial position, okay, they are all financially okay. When you look at the debt equity ratio, it has come down significantly. Okay, today compared to a decade ago, the current ratio has gone up significantly. Okay, so the sector has a sales problem, but it doesn't have a financial problem. Okay, so the good sign is that I think all the glove companies are financially sound, so that as they try to tackle the production problems and the revenue problems, at least they don't have to worry about the funding problem. Okay? Can you imagine that if you have to worry about funding and demand, like what happened to Sapura, that will be even much more challenging problems to have. So when you step back and look at the sector, we find out this is a sector that has been suffering from declining returns. It currently has excess production capacity. Revenue is projected to grow at low single digits. Okay, and there are, I would say, either immediate to short term profit challenges. Okay, the only good sign is, of course, it is financially sound. Okay, but it is a tough sector to make money. Now, I want to dig a bit deeper into the Top Glove and Care Plus. Okay, and I'll use it reference to the Fundamental Mapper. Okay, see, the Fundamental Mapper is the app that we have developed that maps the companies based on the business performance and the investment risk, and then we classify them into 4 quadrants. Okay, based on whether it is good business performance, low investment risk, versus high investment risk and poor business performance. Okay? And when you look at Top Glove and you look at Care Plus, okay, on the right side of the mapper, okay, the rightmost is the best performance, the leftmost is the worst performance in terms of fundamental. The, the, the upper section means it's very risky, the lower section means less risk. The key feature of Top Glove and Care Plus is that they are different sizes. Okay, I think in terms of total equity, Top Glove is about 20 times bigger than Care Plus, but both of them have poor fundamentals. Okay, Top Glove is what I call the quicksand quadrant. That means high investment risk, low business performance. Care Plus is poor business performance, slightly lower risk. Okay, and when I dig deeper into detail, my objective was see, are there prospects for them to improve their fundamentals so that they go into what I call the low risk, good performance quadrant. Okay. And to do this, I look at 4 areas. I look at profitability, I look at the growth prospects, I look at what I call reinvestment, how much they need to rebuild back as they grow, how much they need to reinvest back to grow, and of course, I look at the business risk. Okay? So let's track the profitability metrics first. Okay? Now, I've placed them side by side, but when you look at it, remember the scale. The scale is different because Top Glove, in terms of revenue and total assets, okay, this is 8 billion, this is 1 billion. So even though it is bigger, when you put it on the same scale, Top Glove is much bigger. Okay? So you can see that both companies grew the total assets significantly, okay, much more than revenue growth. Okay, so when you look at asset growth, okay, and you think in terms of assets as capacity growth, okay, so Care Plus went from about 30-40 million to almost 400 million, okay, a very significant increase in total assets. Top Glove went 7 times, okay, increase in total assets, okay, but the revenue growth was not 7 times, okay, and because of this discrepancy between assets and revenue, you can see that for both companies, the return of assets dropped dramatically. So this is on the left-hand side, 210 for Care Plus, 15% for Top Glove. In 2024, both companies incurred losses, okay, because the revenue were below. They were basically operating below the break-even levels. Okay, the cost has gone up so much that if you don't increase their revenue significantly, they will never break even. Okay, so we have a situation where costs has gone up, revenue has gone down, okay, and they've been squeezed up. Okay. Now, this is another picture of the capacity, okay, in terms of number of production capacity in terms of billions of gloves. Okay, so for Care Plus, okay, it went from 4 billion to 11 billion, okay, in terms of the production capacity. So you ramp up this capacity, okay, because of COVID, more than double. Okay, Top Glove went from 64 billion to 100 billion in terms of production capacity. This is the number of gloves. Okay, and when you try to plot revenue, okay, this is the revenue trend against the increase in capacity, I think you can see very clearly that they build up the capacity to cater for the peak period, demand drop, and today they are all suffering from the excess capacity. So the red line here is the historical capacity before COVID. This is post-COVID. Okay, so you can see for 2 companies before and after, and you can also see the revenue COVID time and currently. So today their revenue is about what it was in 2014 to 2015, okay, but the capacity is much higher, and because they have invested in the plant and machinery, there are depreciation charges, there are interest charges, and so on. The cost has gone up. Okay? So to even break even in 2024, okay, they must sell more than what they sold in 2014-15, okay, because the cost has gone up. So the biggest challenge for two companies is that high capacity, lower demand. Okay, they just reflect the industry position. Okay, and we are not surprised for that. Now, theoretically, there are several ways in which you can improve or return to profitability. Okay, of course, the first, of course, to grow the top line. They can try to expand their margins. They can try to reduce the fixed costs, management overheads, selling costs, and of course, if you look at returns, they can also try to reduce the assets. Now, I've mentioned earlier that the market research report shows a sector growing at 5 to 6% over the next 8 to 10 years. So trying to grow revenue, okay, trying to ramp up revenue, unless there's another pandemic, okay, try to ramp up revenue very fast is not going to happen. Okay, the revenue growth is not going to double or triple. Okay, you're not going to have a 15% revenue growth. Okay, I think it's going to be 5-6%. And it's going to take a long time to go beyond the break-even level at this revenue growth. Now, I then look at the detail and see, are there prospects for them to actually expand their margins or reduce the fixed costs? So margin expansion is basically saying, hey, can I increase my selling price or reduce my variable cost to increase my gross profit margins? Fixed cost is about my selling costs, my admin costs, head office costs. Can I reduce it? So when you look at the margins, for example, okay, the purple bar is for Care Plus. Okay, so you can see in 2010, okay, they had a gross profit margin of about 25%. Okay, in 2024, it was a negative. Okay, that means basically they were selling below their production costs. Top Glove is a bit better. They had 20% margins, smaller margins in 2010, but the margins has dropped by half, so that is around 10%. Okay. Now, when you look at the fixed cost, the leap is even worse because it went from 10%, okay, roughly about 10% of both, to about 25. So it went up by 2.5%. Okay, and I suspect a big part of it is depreciation, interest charges, and so on, to maintain their investments in their fixed assets. So I reckon that the both of them, okay, would have a tough time trying to improve the gross profits or even reduce the fixed costs. Looking at this picture, I would imagine that probably Care Plus will probably have a much tougher job than Top Glove. Now, I've already mentioned that whatever they try to do on the cost side, they are facing cost pressures. Malaysia is introducing, trying to increase their wages for the workers. I'm not sure whether they remember the story about how the US was picking on Top Glove, saying that they didn't take care of their workers and so on. So the regulatory environment, international regulatory environment, has become more stringent. Okay, and so I'm not sure. I don't think they are able to go back to the historical costs. They're stuck with the current costs. Okay, and hopefully both companies have invested a bit more in automation, and I think they are looking at that to reduce the production costs. That is still something yet to be proven. Okay. Now, to give you another perspective of how tough it is to reduce the gross profit margin, the lines are the sector margins. Okay, the upper quartile. The blue line is the median, and the orange line is the lower quartile in terms of the gross profit margin. On the left, the purple bars are the gross profit margin for Care Plus. On the right, the green bars are the gross profit margins for Top Glove. You can see that Care Plus has a much tougher job because they have gone negative. Okay, at least Top Glove, although it's reduced, it is still positive. But when you look at what, okay, forget about Care Plus because they need to turn it positive. But when you look at Top Glove, what they're achieving today is even much lower than what they achieved, in 2014, 2015, even before the pandemic. So even the better company has a much more tougher, longer journey to go. Okay, even though it is positive today. Care Plus, I think they need to ramp up the revenue a bit before to go beyond the break even. If not, it is very tough for them to get a positive profit margin. Now, so far, I've been looking at trying to improve the profitability of returns, looking at what I call the numerator, the top side, the numerator side, profits. That means grow revenue, reduce costs, improve margins. Okay. Now, there's another way, of course, that you can improve returns by managing your capital well. Okay. Can the companies improve their capital management? Can they reduce the capital employed? Okay. So there is another way, and I also explored this prospect. So this is looking at it from the return of assets. Okay, so you can see the growth. The blue lines are the total assets. The blue bars, sorry, are the total assets, and you can see that if they are going to manage the assets, they will need a significant reduction in the assets. Okay, assuming that of course they can grow the revenue a bit and make the profit profit before tax or profit after tax positive. Okay. Now the challenge with assets reduction, and I'm not sure whether how many of you remember, about maybe 5 to 6 years ago, okay, even before the pandemic, the oil and gas companies, especially those in the drilling and the offshore supply vessel, okay, suffered because the industry, the oil prices fell, okay, and a lot of the oil and gas companies, especially the offshore supply vessel companies, had to write off their assets, okay, and people like, I can remember, people like Dayang, for example, who bought over Perdana, okay, had the write-off, and because of the write-off, they suffered a big drop in profits. Okay. Now, the glove companies are no different because today they have excess capacity, and the accounting requirements is that if you have unused assets, there's an impairment test. Okay, every company goes through this process, and over the last few years, both Top Glove and Care Plus had to write off their assets. For Top Glove, they wrote off so far about 200 odd million, or about 3% of the total assets. Care Plus wrote off 75 million, but because it's smaller size, it represents 15% of the total assets. I'm not sure, given the excess capacity, whether there will be more impairments. Now, if there are impairments, okay, it's going to be a short-term pain for the shareholders because it is all going to affect the bottom line. Okay, so any asset management at this point in time, if they're going to manage the assets by writing off, then they're going to have a lot of problems. Now, if the industry was doing well, you can manage the assets by selling it off. Before the downturn in the, for example, in the oil and gas sector, some of the international oil and gas companies, the drilling companies, for example, sold their drilling assets to Sapura. Okay, some of the offshore vessel companies, the international one, the bigger ones, started selling their assets, okay, to the smaller ones, okay, who were less experienced and didn't realize that they had too much assets. So in good times, you can actually manage your assets by selling it off to people who wanted to have additional capacity. But if you have a situation like today where there's excess capacity, remember, Malaysia supplies to almost 60 to 70% of the global demand. So we are a big player, and if the big player like Malaysia has excess capacity, I'm not sure whether you can find buyers in other countries who wants to buy the capacity. So I don't think managing the assets by selling it off your capacity is one option available to all our Bursa players. The worst would be, I suspect that one or two of them may have to incur additional impairments. So it is a challenging situation. The positive sign, of course, is that I've already mentioned, when you look at the financial situation, both Top Glove and Care Plus, you find out that financially they are okay. 7% of that equity level is very low. Okay, normally most companies try to keep their debt equity below 1. Okay, this is very low. The current ratio, measuring current assets over current liability, when I look at companies, my target is 2. They're basically operating around what I call very good levels. Okay, so both these companies, and I suspect all the other companies, if you look at them, are financially sound. So the issue is not finance, like I said earlier. They have to worry about demand and managing costs, which is a different ball game altogether. Okay. Now, although they are different sizes, okay, and I won't go in details here, but basically, Care Plus and Top Glove basically adopted the same sort of strategy. The only difference is that because of their size, the implementation and costs are different. But basically, what they're trying to do is that they all know they got excess capacity. They know that the demand is not there. They are facing rising costs, and there is impairment risk. And the biggest challenge is how do you right-size production while waiting for your demand to pick up. So they have, for example, shut down production lines. Okay, that reduces some of the running costs, but it doesn't remove the depreciation and interest charges. They have gone into a bit more into automation, and there's some talk about AI as well to help manage and reduce the production costs. Okay, but the biggest one, of course, is that unless we have another pandemic, I'm not sure that there's going to be a surge in demand, and it is a question of slugging it out for the next 2 to 3 years until your demand picks up. Or for some of the companies, they're hoping that you want to go above your break-even level as soon as possible, okay, rather than wait for another 3 to 4 years to go there. So it is a very, what's the word I use? It's a very challenging business to run at this point in time. Okay. Now, when you look at simple valuation metrics, okay, and I look at price to book, okay, the current market price of Care Plus is below the book value. Top Glove is a 1.7 times the book value. This is the latest financial that we've got. The challenge with price to book is, of course, if there's impairment, then the book value is affected. Okay, so this metric will be affected as well. The price to book is a good metric if the company is running normally and so on, and there are no impairment risks. Here, I worry because I think the price to book will probably go up when further impairments kicks in. Now, when I look at PE, I ignore what happens for the last 2 years and say, if they can go back to what it was before COVID, okay, and deliver the average profits, okay. So this is looking at what I call a normalized performance before COVID. What is the current PE? And you see that both of them are trading way, way beyond PE 10, PE 15. I mean, if you ask me, these are very high PE. Okay. So the two companies, if you ask me from a fundamental perspective, they are definitely overvalued relative to their historical profits. Okay. So the question was can they improve the historical profits? Okay, your guess is as good as mine. Okay, now that's looking at the glove manufacturers. What about the suppliers? Okay, there are three of them. One does the gloves for the whole industry. Another does the chlorination system used by the glove manufacturer, and of course, HLT Global does the glove dipping line. Now, just to give you an overview of how the glove suppliers have performed relative to Top Glove and Careplus, I tracked the return on capital for the past 8 years for these 5 companies. So the blue one here, this is Top Glove. Okay, you see declining. The black line here, okay, is Careplus. Okay, and the green is ES. You get a Flex Dynamics. Okay, so you can see that basically you should not be surprised because they supply to the rubber glove manufacturer. If the rubber glove manufacturer don't expand, you can expect their business to be affected if they are going to be equipment suppliers. I don't think it's any brainer. Okay, the difficult part is that you see over the last couple of years, they are basically the return is just hovering below zero, around zero. It's not a fantastic. Some of them are losses. Okay, those are profitable are just hovering around zero. It is not a fantastic position to be in. It is not a fantastic company looking at it from a fundamental perspective. My overview, my first impression looking at this, and standing back and looking at this is a tough sector to make money over the next 1 or 2 years. Whoever is running these companies, okay, if they don't have a long-term view, if they are not have the perseverance and so on, I think the company will probably go under. But it is a tough sector to make money, and I will be very interested because I have not looked at the market price. But if the market price does not reflect this and the market price is shooting up, I don't think the market price is going to reflect the business fundamentals over the next 1 or 2 years. So that's basically my fundamental analysis of the glove sector and the 2 companies. Disclaimer, this is of course educational. This is not an advice on whether to invest or not to invest in this company. But more important, I hope that I've shown you that the fundamental mapper gives you a good and simple way, if you don't want to dig into the numbers, to have a quick feel of whether this company is a relatively good or poor investment. So for those of you who have not downloaded the CIFO app, scan and download. All right, thank you.
Okay, thank you very much, Dato.
We'll do it later.
Okay, thank you, Dato. Okay, any questions from the audience regarding the section from Dato earlier on? Okay, I think Dato do share with us some of the information and insight, okay, regarding glove sectors. So I think Dato, in short, is that unless there's another pandemic, if not, 1 2 years we try to avoid lah. Of course, we are not doing buy and sell call. I think like Dato said, disclaimer here, we are not doing any buy and sell call. Okay, just that I want to share some of the informations that we have with us. Okay, especially using the fundamental mapper from Seafood. Okay, let's say there's no questions. Probably I will share a little bit regarding the technical parts. Okay, we look into the chart, especially for these 2 counters over here that Dato shared with us earlier on. Okay, if you got any questions, you can actually comment below, and then I can take a look into some of the so-called chart or questions too. Okay, hopefully my screen is working on my side. Okay, so yes, type 1 for me. Thank you. Okay, but one things I do kind of like agree with Dato is that comparing these 2 counters, Top Glove, K plus, definitely K plus, somehow they are not in a very good so-called positions currently. Okay, now if we compare both side by side using weekly chart, okay, this is a weekly chart Top Glove. Okay, on your left hand side we have K plus, on your right hand side we have top glove. Okay, so again both hit badly recently, but one thing I think for those that who are interested in K plus, or probably you are still holding K plus, one thing to take note is that they actually break a very crucial support. Okay, so this is the period support. I think somewhere around 23 cents. Okay, let me just draw the line. Hopefully you can see that. Sorry, my screen is a bit small. Later I can put it up bigger a bit. Okay, again, if you got any questions, okay, regarding glove, comments below. Okay, so that probably we can answer these questions. Okay, answer questions. Okay, now again, previously on this weekly basis, we have one support tested several times. Okay, and recently just break. Okay, now again, this is a major support, and they just break below. Okay, so few things that I think you have to consider. Okay, if you are currently are still holding into K plus. All right. So I think I kind of like agree with Dato lah. I think just now he shared with you also the performance overall. Okay, for in terms of fundamental perspective, looks like top glove is slightly better. Okay, in this case over here. Okay, now this is on weekly basis. Now let's take a look into top glove right now. Okay, we take a look into top glove. Okay, top glove currently is slightly better, but again, it based on weekly chart as well. I think that is a bit tricky lah. So looks like today. Okay, now this is the previous low over here, touching somewhere around here. Looks like today it break slightly. Okay, so we will know again next week. Today just it touched slightly a little bit low on the so-called the short term, not to say short term, but this trend lines over here. Okay, break slightly on weekly chart basis. So again, for those that who are uh interested, okay, in top glove, or maybe you want to look for uh entry opportunity, or maybe you're holding currently, this is a very crucial area to watch out to. Okay, so breaking below this level, I think they were kind of like similar with what happened to K plus, which is they're going to retest back, okay, to the main support area, okay, which is around 63 cents level. All right. So okay. Any questions so far regarding top glove and K plus? Okay, 65 level 65 level is the previous so-called main support level for top glove based on looking on weekly basis. Okay, now if we look into short terms, okay, short terms, I know some of you prefer short terms. Okay, again, two ways to look into this. Okay, because this is actually dropped badly and it's far away from 20 and 40-day moving average. So normally, yes, some people ask me, probably they will do a take a rebound. Now, if you are someone that actually looking for like very short term, especially I know some of our user, they like to do like control kind of tradings, they will look for the opportunity to rebound. Okay, now if you are this type of trader looking for a short term rebound, probably 3 days, yes, I think they will have opportunities. Okay, but of course, not now. Okay, because I cannot see any so-called patterns. Okay, forming in the chart. Okay, but if you are like what Dato share. Okay, you are planning to hold maybe slightly mid to long term. Okay, or a few years down the road. Okay, currently also looks like it's not a very good area to look into. Okay, now a few things that probably I would do, if let's say for those who are looking for short-term opportunity, against if you are using seafood apps, you can try out. Okay, if you are new to our seafood apps, sign up, you get 30 days free. You can access to fundamental mapper to check your overall fundamentals, so-called classifications in FM fundamental mappers. In the same time, also you can access to XChart, its lifetime. Okay, 30 days for free. You can use in weekly, daily, hourly chart. Okay, of course, some of the so-called indicators we actually have that as well too. Okay, now for me, I'll look into hourly charts to look for the setups. Okay, if let's say hourly chart didn't show, like here it didn't show setups. Okay, unfortunately for me, I prefer to have a price crossing above my 20 and 40-day moving average with a slight pullback. I think would be nice. Okay, currently, but today we still don't have it. But anyway, Bursa markets have been down. Okay, I think since I think before CM until now, it has been like this really. We don't have any so-called a nice opportunity for even for short-term trading for these few days. Okay, So okay, now this is Top Glove. Let's take a look into daily chart in K plus. Okay, any other counters or any questions you want me to you want to ask me and Dato you? Okay, you are welcome to do so. Okay, but unfortunately, K plus is the same. Yeah lah, drop below volume. Okay, so probably this one is good. You wait for a shakeout opportunities. All right. Okay. If let's say there's no questions, okay, Dato, any others uh so-called information you wish to share with us before we end our section for tonight?
No, I'll write. I think I'll probably do a proper write up and then post it in the next couple of weeks. More
Oh,
detail.
okay. Also, you will prepare a so-called write-ups into a
Yeah.
Sifu blog, right?
Yeah. Mm.
Okay, great. Okay, so once Dr. Yu have prepared the write-ups, I will post it into Telegram for everyone to view. So again, with this, once again, thank you, Dr. Yu, for joining us for tonight. So we have another sections again for next 2 weeks, Dato.
Yep.
Okay, we have another section. Okay, so for those that are our user or member, if you got any specific topic, okay, that you wish Dato Yu to cover, I think okay, right, Dato, right? They can
Yep.
send it
Mm.
to us, then we can maybe prepare according to the topic. Okay, so with this, once again, thank you, Dato Yu, for joining us in
Okay.
the live Facebook, and I will see you again in the coming section. Thank you, Dato.
Okay. All right. Okay.